Welcome back, traders. We need to have a look at the basics of how to read a Forex quote. And we're going to go through a few of the basic terms which people get a little confused because it's not always that clear, just to get you up to speed with some of the lingo that we're using. In the example of the euro dollar, the euro is what we would consider as the base currency, and the US dollar is the quote currency. For example, 1 euro equals 1.2250 US dollars. We are saying that 1 euro will give us $1.2250. So we are being quoted a value in dollars to the euro price. If you think the euro will strengthen, then you would want to buy more euros. If you think the euro will weaken, then you want to sell euros. Remember, the US dollar is sitting on the right. So if the US dollar will strengthen, then you want to sell, because a stronger dollar means that the euro will weaken in relation to the US dollar. A pip is 1/100th of a cent, and this is where Forex traders make their money. Let's take an example exchange rate of 1.6069. So if the market moves from 1.6069 up to 1.6089, it means it moved up by 20 pips, or you could say that the base currency strengthened by 20 pips. Depending on how much you traded, this could be a small amount of profit or a lot. With a $5,000 account, you could trade $10 per pip and make $200 off a small trade like that. It should be noted again that Forex trading is a risk, and if you went the wrong way, you could have also lost $200 on a trade like that. These days, we also have points, which is 1/1000th of a cent, which is the 5th decimal place. We will go over this again and again when we actually have MetaTrader loaded up and we're going through the software. Just please keep in mind that a pip is the 4th decimal place. It is still the one that we refer to the most because it is the original. It used to be the smallest one we could trade, but now brokers are allowing a 5th decimal place, which is a point. So don't get those two confused. It could cost you a lot if you're miscalculating your stop losses. But this is why we have demo accounts. When traders start saying that they're going to go long or go short on a particular currency pair, for example, if I say I'm going long on the euro dollar, it has nothing to do with how long I'm going to be holding the trade. It means that I am buying on the euro dollar because I'm expecting a bullish market. This is when I'm saying the euro is going to strengthen against the dollar. If I say I'm going short on the euro dollar, once again, it has nothing to do with time. It means that I'm selling, or I'm expecting a bearish movement on that pair. The bid price is the price that the broker is willing to purchase the base currency from you. The asking price is the price that the broker will sell the base currency to you. Now keep in mind that the broker does want to make a profit. So if you are saying you want to, say, sell on the euro dollar, and there is a certain exchange rate for that pair, the broker will be willing to purchase euros from you at a slightly reduced rate to what it's actually worth. If you're wanting to buy euros, then the broker will charge you a slightly higher rate than what the euro is worth. The difference between the bid and the asking price is the spread. This is where brokers charge, and this is where they make the money. The nice thing is that the price is included up front in the trade, at open, and again at close. So once you've closed it and you see the money in your history, that is yours. Everything has been paid for already. I like it because it is an upfront system. What you see is what you get at the end of the day. Different currencies will have different spreads depending on how popular they are or how in demand they are at that exact time. You'll find that it is a lot tighter on the common pairs like the euro dollar, and one of the reasons why I don't trade the South African rand is because it is 20 to 30 times more expensive to trade than the typical scalping pairs.